Welcome back to Journey to XRP. Yesterday, we talked about something that a lot of people didn't want to hear. The silver rally was unsustainable, not emotionally unsustainable, not it feels too high, but structurally unsustainable. And now, within a very short window, silver has already pulled back hard, dropping sharply from its recent highs. That doesn't make anyone a genius. It simply confirms how cycles behave when they stretch too far, too fast. But this video is not about celebrating being right. It's about understanding what this shift actually means and why most people are looking in the wrong direction right now, especially in crypto and especially with XRP. Let's slow this down. Precious metals move in cycles just like everything else. Silver in particular is notorious for violent upside moves followed by equally violent corrections. When silver starts going vertical, it's usually a signal that fear, inflation concerns, and macro stress are peaking, not that the party is just getting started. Historically, those moments don't last. They resolve through correction and rotation. And that rotation is what matters. Capital doesn't disappear when silver corrects. It looks for the next asymmetric opportunity. Sometimes that's gold, sometimes it's equities, sometimes eventually it's digital assets. But these transitions take time. They do not happen overnight, and they almost never happen when retail expects them to. That's why it's important to say this clearly. I do not believe crypto or XRP suddenly explodes tomorrow or next month. In fact, I think it's very possible that crypto stays frustrating, choppy, and underwhelming well into 2026. That's not a bearish statement. That's a cycle statement. What is happening right now is positioning. And this is where psychology becomes more important than charts. I've been reading the comments, and honestly, there's a contradiction that keeps popping up. For months, people were saying they would do anything to buy XRP at these prices again. They said they missed the opportunity. They said they'd be grateful if the market gave them another chance. Now, the market has done exactly that. And instead of gratitude, a lot of people are angry. Why aren't we higher? Why is nothing happening? This feels dead. That reaction tells you everything you need to know about why most people miss generational moves. Opportunity rarely feels good when it arrives. If it felt exciting, obvious, and comfortable, it wouldn't be an opportunity. It would already be priced in. The market creates opportunity by making people doubt themselves at exactly the wrong moment. That's not manipulation, that's human behavior playing out in real time. This is also why calling for massive upside right now misses the point. Big cycles don't reward impatience, they reward preparation, and preparation usually happens during periods of boredom, frustration, and disbelief. Silver correcting is not the green light for instant crypto euphoria. It's the first domino in a much longer chain. Historically, these transitions stretch across quarters, sometimes years. Anyone promising immediate fireworks is either misunderstanding the cycle or selling excitement. And here's the uncomfortable truth most people avoid. If you need constant confirmation from price to stay confident, you're not positioned, you're speculating. Positioning is quiet, it feels slow, it often feels wrong. That's where we are now. This phase is not about celebration, it's about awareness. Understanding that capital rotates before narratives change, not after. Understanding that the market gives you time, but only if you don't panic when nothing seems to be happening. In the next section, we'll move forward and talk about why people emotionally collapse during these phases, why they complain when they finally get what they asked for, and how that behavior repeats every single cycle without fail. That's where the real opportunity or mistake gets locked in. Now let's move forward, because this is where most people sabotage themselves without even realizing it. The market has a strange habit of giving people exactly what they asked for and then watching them reject it. For months, XRP holders were saying the same thing. If we ever get another chance at these prices, I'm loading up. That narrative was everywhere. People were convinced they had missed the opportunity of a lifetime. Then price comes back into that zone, and suddenly the tone changes. Now it's frustration, now it's anger, now it's, why aren't we higher, or this thing is dead. Nothing fundamentally changed between the moment people wanted these prices and the moment they got them. What changed was emotion. This is one of the most consistent patterns in all markets. When prices are high, people feel confident but hesitate to buy. When prices are low, people want certainty before acting, and certainty almost never exists at the point of maximum opportunity. This is why cycles don't reward consensus thinking. By the time something feels obvious, it's usually late. The real opportunities appear when the narrative is uncomfortable, boring, or actively annoying to engage with. Right now, XRP sits in that exact psychological zone. There is no hype, there is no excitement, there is no sense of urgency, and that's precisely why this phase matters. Markets don't create generational entries by making people feel smart. They create them by testing patience. Long stretches of sideways action, red days that feel unnecessary, and constant comparisons to what could be doing better are how positions get shaken out. Most people don't sell because they stop believing in the asset. They sell because they stop believing in themselves. This is also why so many people misread timing. They expect opportunity to arrive with momentum, headlines, and validation, but real positioning happens before momentum shows up. It happens when price action feels disconnected from the long-term thesis. That disconnect is where doubt creeps in, and doubt is the market's most effective tool. Another mistake people make is confusing waiting with wasting time. When price isn't moving, people assume nothing is happening. In reality, this is when positioning happens quietly. Institutions don't chase candles. They allocate during low volatility, low excitement environments. Retail, on the other hand, tends to do the opposite. Retail waits for confirmation, and confirmation usually comes with a higher price. That difference in behavior is not accidental, it's structural. And here's the part that's hard to accept. Most people don't miss the move because they weren't aware. They miss it because they were emotionally exhausted before the move started. Months of boredom convinced them to disengage. A few red weeks convinced them to wait for clarity. And clarity often arrives only after the opportunity has already shifted. This is why you hear the same regrets every cycle. I knew about it early. I just didn't expect it to take this long. I thought I'd have more time. Time is exactly what the market uses against you. This doesn't mean price can't go lower. It doesn't mean volatility is gone forever. It means that emotional reactions are a poor compass during this phase. People who anchor their decisions to how they feel about price action in the moment almost always end up reacting instead of positioning. And that's where the real cost shows up, not immediately, but later. The market doesn't punish you for being wrong. It punishes you for being impatient. And impatience usually shows up disguised as logic. I'll just wait for a better entry, or I'll get back in when it confirms. Those phrases sound reasonable. Historically, they're also how people end up watching moves they once had access to. In the next section, we'll move forward and tackle one of the biggest sources of confusion right now, the macro narrative. We'll break down why popular models and predictions may no longer apply cleanly, why some well-known analysts could be wrong this time, and why expecting a repeat of past parabolic cycles may be the most dangerous assumption of all. That's where this gets uncomfortable, but necessary. Now let's move forward and address the macro narrative that's confusing a lot of people right now, because this is where expectations start getting distorted. Many investors are still anchored to the old crypto playbook. They expect a clean, explosive cycle that looks like 2012, 2016, or 2020, big parabolic runs, massive upside in a short period of time. What some analysts describe as the banana zone. One of the loudest voices behind that framework is Raoul, who believes we're still early in another major parabolic phase. Here's the problem: markets evolve. The crypto market today is not the crypto market of 2012, 2016, or even 2020. Back then, crypto was obscure, adoption was tiny, awareness was limited. Capital entering the space created violent, exaggerated moves because the market was small and fragile. That is no longer the case. Crypto is now widely known. Institutions track it, governments regulate it, ETFs exist, infrastructure has matured. When a market reaches this stage, the nature of cycles changes. That doesn't mean upside disappears. It means upside becomes more compressed, delayed, and selective. This is where I disagree with the idea that we're guaranteed another massive, obvious banana zone in 2026. Could it happen? Yes. Is it inevitable? No. Expecting the same level of parabolic growth ignores how much capital, awareness, and structure already exists. Markets don't hand out identical returns as they mature. They demand more patience and punish simplistic expectations. In fact, there's a strong argument that we already saw a version of that speculative blow-off earlier in 2025 when Bitcoin pushed into new all-time highs. That move aligned closely with the halving narrative, ETF hype, and peak optimism. If that was the easy money phase, what comes next is not fireworks, it's digestion. And digestion often looks ugly. This is where people get trapped. They hear bullish macro voices calling for higher, 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 and they assume downside is impossible. But history shows something very different. The loudest permabulls almost never call the top. They stay bullish because their framework requires them to be bullish. That doesn't make them dishonest, but it does make them biased. I would love to be wrong here, truly. I'd love to see explosive upside straight into 2026, but ignoring risk because upside sounds better is not analysis, it's hope. What I think is more likely is a prolonged, frustrating period where price grinds lower or sideways into early or mid-2026. Not because crypto is broken, but because markets need to reset sentiment, flush leverage, and rebuild confidence before sustainable upside can return. That process doesn't feel bullish while it's happening. It feels like doubt. It feels like exhaustion. It feels like people saying, this time is different. Maybe crypto is done. And ironically, that's often when the foundation for the next phase is being laid. This is why blindly following popular macro narratives can be dangerous. They work until they don't. And when they stop working, they usually stop working at the worst possible moment. The takeaway here isn't to be bearish, it's to be realistic. If you're positioned for instant gratification, this cycle will likely disappoint you. If you're positioned for a long, uneven transition where volatility creates opportunity instead of excitement, you'll be far more prepared. In the next section, we'll move forward and talk about the real risk most people are ignoring, recession signals, the yield curve, and why a potential macro downturn in 2026 could be the final shakeout before the next true expansion. That's where patience gets tested, and where conviction is either built or broken. Talk about the risk almost nobody wants to price in properly, the macro backdrop going into 2026. This is not about fear-mongering. It's about understanding where we are in the broader economic cycle and why that matters for crypto and XRP specifically. One of the most reliable recession indicators in modern market history is the yield curve. Over the past century, recessions have rarely appeared out of nowhere. They tend to arrive after the yield curve inverts, then turns positive again, and continues to steepen for several months. That pattern has repeated before major downturns in the early 1990s, the early 2000s, the global financial crisis, and again heading into 2020. Right now, that same process is underway. The curve has already inverted. It has begun to turn. And while we are not in a recession yet, history suggests that the most dangerous period usually comes after investors start feeling comfortable again. That lag is exactly what catches markets off guard. This matters because risk assets do not bottom at the start of a recession. They usually bottom after the damage is visible, after sentiment collapses, and after most people have emotionally given up. Crypto is not immune to that process. In fact, it often amplifies it. If this pattern plays out in a familiar way, the first half of 2026 could be extremely uncomfortable. Growth slows, liquidity tightens, volatility increases, and the narrative shifts from optimism to survival. Headlines turn negative. Social media turns toxic. People who were confident just months earlier start questioning everything. That environment is where real bottoms tend to form. Not because things suddenly improve, but because expectations finally reset. This is where a lot of people make their biggest mistake. They assume that if a recession hits, crypto must be finished. But history shows the opposite. Some of the strongest long-term crypto entries occurred during or just after periods of maximum macro stress. The problem is that those moments never feel safe when you're living through them. They feel like failure, they feel like regret, they feel like the end of the story. That's why most people don't act when it matters. They wait for clarity, and clarity usually arrives after price has already moved. If we do see a recessionary shock into early or mid-2026, it's very possible that digital assets establish their true cycle bottom during that period. That doesn't mean instant upside. It means a slow, painful rebuilding phase that almost nobody wants to participate in. That's the irony of markets. The phase that sets up the next expansion is the phase that drives most participants away. And this ties directly back to what we discussed earlier about psychology. People who are mentally prepared for volatility tend to survive these periods. People who expect smooth progress almost always panic at the wrong time. Confidence collapses, not because the thesis is wrong, but because the waiting becomes unbearable. This is also why timing is so difficult. You don't get a clean signal that says the bottom is in. You get a stretch of chaos, bad news, and emotional exhaustion. By the time sentiment improves, the opportunity has already shifted. Now, none of this is guaranteed. Macro indicators can be distorted. Policy responses can delay outcomes. Governments can redefine terms. But delaying a cycle does not eliminate it. It usually makes the eventual adjustment sharper. The responsible approach here isn't to predict exact dates or prices. It's to understand the sequence. Expansion leads to excess. Excess leads to correction. Correction leads to opportunity. And opportunity rarely looks attractive when it arrives. We'll move forward and bring everything together. We'll talk about strategy, discipline, and what actually separates people who benefit from these cycles from those who spend years explaining why they were almost right. That's where this conversation becomes practical, not emotional. Now let's move forward and close this out properly, because this is where most people either protect themselves or repeat the same mistake they've made every cycle. Everything we've discussed comes down to one uncomfortable truth. Markets don't reward intelligence, access to information, or even being right early. They reward discipline. And discipline is hardest to maintain when the environment feels hostile, boring, or hopeless. Most people don't lose money because they chose the wrong asset. They lose money because they couldn't sit with uncertainty long enough for the thesis to play out. This is why cycles feel so cruel. At the top, confidence is everywhere. People feel smart. They feel validated. They believe risk is behind them. That's usually when risk is highest. At the bottom, confidence disappears. People feel stupid for holding. They start questioning whether the entire idea was flawed. That's usually when opportunity quietly reappears. The transition between those two extremes is where we are heading. If the macro setup we discussed does play out, slower growth, recession pressure, tightening liquidity, the next year could be mentally exhausting. XRP may not behave the way people want it to. Price could stay suppressed. Volatility could shake people out. Narratives could turn sharply negative, and that's exactly the point. Markets don't need everyone to sell. They just need enough people to give up, enough people to disengage, enough people to decide it's not worth the stress anymore. That's how positions quietly change hands. The people who tend to benefit from these environments are not the loudest or the most confident. They're the ones who accept that discomfort is part of the process. They stop trying to force outcomes. They focus on managing risk instead of chasing excitement. This doesn't mean blind holding. It doesn't mean ignoring reality. It means understanding the difference between volatility and failure. Volatility is noise. Failure is structural. If the long-term structure remains intact, adoption, infrastructure, regulatory clarity, real-world use, then volatility becomes an opportunity, not a threat. But you only see it that way if you're emotionally prepared to sit through periods that don't reward you immediately. That's the lesson most people never internalize. They remember the regret later. They tell themselves they should have held longer. They say they knew it would recover, but knowing something intellectually is not the same as being able to live through it emotionally. This is why overconfidence is just as dangerous as fear. Promises of guaranteed outcomes, perfect timing, or easy money create false expectations, and false expectations break people when reality doesn't cooperate. There are no guarantees here. Crypto could take longer than expected. XRP could underperform for extended periods. Macro conditions could remain challenging. Anyone telling you otherwise is selling certainty, not analysis. The edge isn't prediction. The edge is preparation. Preparation means understanding cycles. Preparation means expecting boredom. Preparation means being okay with feeling early, late, and wrong, sometimes all at the same time. And preparation means not tying your identity or self-worth to short-term price action. Before we end, I need to make this clear. Nothing in this video is financial advice. This content is for educational and informational purposes only. Markets are volatile. You can lose money. You should always do your own research and make decisions based on your own financial situation, time horizon, and risk tolerance. If there's one thing I want you to take away from this video, it's this. The market doesn't defeat most people through crashes. It defeats them through time, through boredom, through doubt, through waiting longer than they thought they'd have to. And the people who survive that phase are usually the ones still standing when the cycle finally turns. That's it for today on Journey to XRP. Stay patient, stay grounded, and don't let short-term discomfort push you into long-term mistakes.